Hello everyone and welcome to this week's FX update. My name's Craig Erlam, Senior Market Analyst at OANDA. I hope you all can hear me okay and you've all had a very nice weekend. It's been a couple of weeks since the last webinar and it's been quite eventful, needless to say. Again, mainly on the political landscape, particularly last week we were lacking in major economic events. This week, we've got a lot more on the economic side. There's still plenty of political events to keep an eye on, and political events that are going to continue to have these kind of market impacts. The Brexit transition deal over the last couple of days has been quite a key one from a UK perspective, created a lot of volatility in the pound yesterday. If you could just let me know that you can hear me, that would be great, just so I don't end up talking to myself for long periods of time. Perfect, thank you. So political events are going to continue to be a thing, are going to continue to be relevant. Donald Trump, for example, is always going to have an impact on the markets. Trade wars or fear of trade wars is continuing to be a theme. The EU released information about its counter tariffs should the steel and aluminium tariffs be signed in by Trump on Friday. Again, no real surprises here, quite substantial. The appearance being that they're targeting big brand names, as well as targeting areas of the country where you've got notable swing states, so targeting important industry for these parts of the country. Not a huge surprise. The point of these countermeasures are meant to be a deterrent rather than the aim of engaging in a trade war. It'll be interesting to see come Friday whether the prospect of them has had an impact or whether further tariffs are announced against the EU. I'm still of the belief that the point of what Trump is trying to do is not to start a trade war, despite his belief that they are easy to win. I don't believe he wants more tariffs. I think this is a negotiating tactic, an attempt to bring China back to the negotiating table. We saw it clearly with NAFTA as well, despite the fact that they were not included in the current deal, but these negotiations are taking place. So I think this is an attempt to pile pressure on Canada and Mexico. I don't think Trump has a broad problem with Europe. I think this is very German-centric. Germany's economy has been very strong. The currency has been very weak because of the region as a whole. And Germany has benefited from an export perspective, gaining what US believes to be an unfair advantage. And you've seen that reflected in its trade surpluses. But there's very little that Europe can do on a German note because they respond and act as a union. That's the whole point. So it'll be interesting to see how that responds, and that political story is going to continue to play out. That has weighed on risk appetite and investor sentiment now for a couple of weeks. The Brexit story has lifted things a little bit from a pound's perspective. I wonder how long that can last, though. The transition deal itself has been criticised by some quarters. That's always going to happen. It's been welcomed by the business community, providing certainty and clarity for the 21 months following the following March of next year, when the UK effectively leaves the single market. Although the reality is we're pretty much still in for a 21 months after. And the fact that they've managed to wrap this up prior to the EU meeting later this week and without any 11th hour deals, I think is positive. The belief is that the UK see the negotiations running till around January next year before a deal is agreed. The EU wants it wrapped up in October. The skeptic in me believes that it's more likely going to be in line with the UK's deadline, because that if one side's working to that, then that tends to be how these things will progress. But the EU's history in these type of negotiations, not Brexit, of course, this is very unique, but when we saw the negotiations with Greece, for example, 11th hour deals are common. So I think this is going to be long running. This is another major hurdle, but I think the hardest part is now beginning. So expect more back and forth, more negotiating in public, and more volatility. I think for another year, volatility in the pound is going to remain, and shocks could occur along the way if things start to get very difficult. But like I say, that's the political side. I'm not going to go into things that aren't really affecting the markets at the minute. The most notable being the UK-Russia relations, the poisoning, who's pointing the finger at who, etc. At the moment, the measures that have been announced in terms of expulsion of 23 diplomats from the UK, 23 UK diplomats from Russia, these are very small measures, not having an impact on the markets. Should we see broader actions taken, then we can go into it, but I don't think this is market relevant right now. The other notable one will be the data leak, not the data leak, but the use of data reports over the last couple of days linked to Facebook, the influence in US election and the Brexit campaign. Again, not market relevant right now, so it's not something I'm going to waste people's time with, especially when we've got so much to talk about this week. We're looking at the economic calendar here. Excuse me. Looking at the economic calendar here, and the thing that really stands out for me this week is it's very UK-centric, barring one very notable event. The G20 meeting here, on a side note, is unlikely to be very market moving, unless you're trading cryptos, because I believe that's going to be an interesting topic, how to manage the crypto environment, regulate from a regulatory perspective. Of course, trade, tariffs is also going to be key here, so don't be surprised to see plenty of commentary coming out of the G20 meeting surrounding that. Like I say, we've got the EU leaders meeting later this week, and again, the transition is going to be key for that. From an economic standpoint, I think the UK is going to be very much in focus. Already today, we've had CPI data, softer than expected, which had a temporary negative impact on the pound, but it was quite temporary, and it wasn't as significant as you may otherwise expect. Now, given that inflation has fallen from 3% down to 2.7%, core CPI, which really is what the Bank of England is mainly focused on, is marginally now above target. It may take longer to get down towards target, but still, these numbers do not suggest, given what's driving them, that the Bank of England needs to raise interest rates. Unless the bank's motive for doing so isn't purely based on the CPI and the belief that it's going to be longer standing. Now, the interesting thing about the market reaction was it suggested that the market almost, while it triggered volatility, the market sees this drop-off as less relevant than it would, for example, under ordinary circumstances or in other countries. So this would suggest that the markets are really buying into what the Bank of England is saying as opposed to what the data is particularly saying, which may suggest there is another ulterior motive. Now, I'm not here to speculate on what that is. It's irrelevant. And when you're trading, the important thing is being prepared for moves. Markets are pricing in a rate hike in May at this moment in time, and that wouldn't surprise me. As you well know by this point, just because it wouldn't surprise me, it doesn't mean I'm particularly in agreement that that's what we should be seeing. But it wouldn't surprise me if we do see a rate hike come May. Worth noting that the meeting on Thursday, in which we'll get the minutes as well as the breakdown of the votes, etc. But of course, we do not get any form of press conference or anything like that. This is the last meeting now before that May meeting. So if we are going to get a rate hike in May, I would expect the Bank of England to strongly indicate that that's the case on Thursday. This is the second rate hike that we've had since the global financial crisis. This is the first rate hike taking us above 0.5% since then. The rate hike we had towards the end of last year was a reversal of the post-Brexit cut. So this is the first really relevant rate hike as far as I'm concerned. This is the first clear-cut signal that the Bank of England is very intent on raising interest rates, not just reversing past cuts. So I would expect a very strong indication in these minutes and from the votes if May is going to be the point at which it raises rates again. Also this week we've got the jobs report on Wednesday, the UK jobs report. Unemployment's remain at 4.4% and earnings to rise to 2.6%, and I think this earnings is part of the reason why the Bank of England expects inflation to remain at these higher levels. So I think that the earnings numbers in particular are going to be a source of volatility for the pound. And then on Thursday, before the Bank of England, we've got the retail sales again. The consumer is a key part of the UK economy, key part of the services industry, and therefore retail sales, a sign of consumer strength, is always very much paid very close attention to. We're expecting a jump from 1.5 to 2.9%. It's worth noting that we have slipped back towards these kind of 1.5 levels in recent months, but 2.9% isn't particularly high. It's more towards the lower end of what we were seeing really from late 2013 onwards. Actually, even prior to that, we were seeing these kind of levels back to 2012. So just because it's a big jump, it doesn't mean it's substantial. It doesn't even mean it's sustainable. That's core sales, overall sales at 0.9%. Again, you can see this very clear trend here. Again, another thing that the Bank of England would typically be factoring in under normal circumstances, which appears to be, I wouldn't say overlooked, because I don't believe they overlook anything, but a sign of weakness in what you typically associate a time of strength when raising interest rates. The other major market event this week, and probably the biggest, if I'm perfectly honest, of them all, is the Fed decision. The Fed decision affects a number of things. Commodities priced in dollars. Rising Fed interest rates has typically been associated with market volatility globally, not just in the US. We saw that about a couple of months ago when the Fed indicated that it was going to raise interest rates faster than expected. We saw what impact the jobs report following had on overall markets. We had the 10% dip in markets, fears of faster rate hikes, higher yields, not just in the US again. The thing we're looking for here, firstly, an interest rate hike. That's pretty much priced in at this point, and I'd be very, very surprised if that doesn't happen. But it's the economic projections which people are very, very focused on. The economic projections will tell us whether Fed policymakers are expecting 3 or 4 rate hikes this year. Previously, it was 3. Since then, we've had tax reform measures passed through. This is we've had the economy continuing to show signs of strength. The language from policymakers has become increasingly hawkish. A number of them have signalled that they would now be leaning more towards 4 than 3 rate hikes this year, and you'd expect that to be reflected. The dot plot, as always, will be key, and this is the dot plot showing where policymakers expect interest rates to be at the end of the year in each of the following years. So again, very important, very noteworthy based on current data. And we'll also hear from Powell for the first time following a Fed announcement. The last meeting, which was his first, there was no press conference. So this will be the first Powell press conference as well. So again, especially if we get upwardly revised economic projections, that press conference could be key, and again, a big source of volatility for the markets. There's plenty more of data to come this week as well, so that's not just it. They're the key standout points as far as I'm concerned. We've got jobs data from Australia on Thursday morning, in the early hours of Thursday morning our time. We've got services PMI from across the Eurozone and manufacturing PMI as well, and then the composite, which is the combination of the two. We've got similar data from the US on Thursday afternoon as well. Inflation data from Canada on Friday. Durable goods orders from the US. A lot of high-profile data coming out throughout the week. I've highlighted the key events for me, but keep an eye on this economic calendar, because particularly in the second half of the week, there is a lot of economic data which could really rattle things in the markets. Okay, that's the fundamentals covered. Let's move on to the charts. So we'll start with euro dollar. It's been a bit, I wouldn't say particularly volatile, because you can see the range is closing. I'd say it's been a bit choppy. Interestingly, though, we keep failing to make new highs, and that's the thing that concerns me to the upside. Even this little boost higher in the euro yesterday on the back of the Brexit announcement, quite short-lived, and today we are seeing a reversal, and we're now trading below yesterday's open. So again, there's a concern for me. This series of lower highs suggests to me we are due a correction. I think, personally, we should be due a correction in the dollar anyway. What we're waiting for here is confirmation, and that will come from a break below this 21.50 zone. That would strongly suggest for me that we are going to see something of a correction here. In terms of how big a correction, it's not particularly important at the moment. I'd be very intrigued to see how we respond around the 120, 119 levels. We're in between the 50 and 61.8 fib at that point. Prior support, prior resistance, closing in on the on these big fib levels, the 200 and 233 day as well. You could see a test at the 89-day moving average as well, being the lower part of that band, but really I think 21.50, 22, if that's broken, it would suggest to me we're heading back to 20 and 19. So something to keep an eye on. But again, we're just seeing a bit choppy at the moment. Perhaps we are seeing traders waiting for that Fed report to give an inclination as to which way we're headed here. With the pound, it's been less choppy. The pound, of course, is more vulnerable to the Brexit negotiations. The UK has more to lose, so that shouldn't come as a surprise. So there's a bit more of an upside beat in response to yesterday's announcement from David Davis and Michel Barnier. Interestingly, though, this fib is still in play. We came back towards the 61.8 fib here. We closed below the 50 fib, failed to go above the 61.8 fib. I wonder if that's a sign of a possible rotation point. Again, I do think the dollar should be experiencing some form of a corrective move at some point. With the Brexit deal announced, the transition deal announced, I wonder whether that is coming in the near term. But again, with Thursday's announcement still to come, I think that would be more of a clue. If the Bank of England signals a May rate hike on Thursday and we fail to break 141, that would be quite a bearish signal for me, because that would suggest to me that anything positive from a sterling perspective is priced in, which doesn't leave, for me, from the known information out there, that doesn't leave too much upside potential and would suggest that we may enter a corrective phase here. We'll see what happens come BOE on Thursday, but we're now pushing below this 140 in the lead up to it. And a failure to get above 141, above that 61.8 fib, in the event of a rate hike being hinted at, would actually be a bearish signal as far as I'm concerned. Euro sterling has been as choppy as ever, although there has been a bias towards the pound. That's not surprising, given what I've just said about the UK being more vulnerable to a bad Brexit deal and therefore benefiting best when things go to plan. But we're still in this range. We just about failed just shy of the previous highs. We broke below the trend line, which has taken us now down to these lows. Again, we've chopped below here a lot, so we can't treat these so precisely. Yes, yesterday we found support here and we rebounded higher. So on this occasion, it did hit that precise level, but you can't always rely on that to happen. We've chopped below here a few times here and once here. The general idea right now, though, is that if we continue to run into support here and if momentum starts to fail us, then that would potentially suggest that this pair's remaining range bound. If momentum picks up with this move, then perhaps we are going to see a more significant break lower as people start to favour the pound. I'm not seeing momentum failing us yet. The MACD histogram potentially has a little bit of a failure here, but the stochastic made new lows, comfortable new lows here. This moving average here as well on the MACD as well made new lows. We'll see what happens on the next test of those 87.50s, whether we actually manage to make a new low. Failure to make a new low, of course, would be a signal all in itself. Should we see a correction, then I'm keeping a close eye on these 88.50s. We've got the 200 we have the 55 and we have the 89 moving average band cluster here. If we're going to see a corrective move from this sell-off and a rotation lower and another test of the lows, then this could be a very interesting level for us. I won't add any fibs left because it's not quite yet, because it's not quite clear that we've made a low, but this would look like it would mark around a 50% retracement of the current high lows. So this could be an interesting level if we do see a failed new low and a rotation to the upside, so potentially a level to keep an eye on. But at the moment, broadly speaking, we are still very much range bound between the 87, 88 levels and the 89, 90 levels above, and we have been for some time. No change as yet in that story. Aussie dollar, we had a nice little rotation. Now, I know what you're probably thinking. You're probably looking at this going, well, you've got a fib to the upside, fib to the downside. What is it you're actually trying to say here? It looks a lot like guesswork, and to an extent it actually is, if I'm perfectly honest. We have been, broadly speaking, longer term, this hasn't been a very strong ranging market. The reason why I had the orange fib on here was simply because we haven't got strong trend here, but we have technically still got a series of higher highs and higher lows. It's just been very gradual. It's been very choppy. It's been a bit messy. Not ideal in the slightest. So I wanted to keep an eye on this level more. And as well, from the low to the highs, we came back. We tested the 61.8 fib. The second time we tested and we held as well. We had the cluster moving averages. That therefore made it a point of interest. It wasn't a point I was particularly confident in. And it may still hold, but what I was more interested in to an extent was how we were going to respond on the 1561.8 fib here. You almost get this support and resistance level. If we had reached a high there and we were going to see a rotation back to the lower point around here, then I would have expected this 50 or this 61.8 to hold, rotate lower, and a new low. If this low is broken, that would give me confirmation of that. However, if the 61.8 holds and this one breaks, then that would suggest we're heading back to these highs in the near term. Again, we're not looking for big signals. We're not looking for signals of major moves, but we are looking for signals as to whether we are remaining range bound. Are we headed to the upper part of the range, the lower part of the range? And when you've got markets as choppy as this, you're not always looking for definitive levels, but a break through that 61.8 fib or a break through that 61.8 fib to the upside or the downside gives us an inclination of that. We've had two very big bearish days here on the back of a failure at the 50 fib. Two very big bearish days. We are seeing consolidation, but we have made new lows. For me, this looks quite bearish, and that would point down towards the kind of 75, 75, 50, back to that support zone that we've noted for the past since June of 2017. This looks like consolidation to me right now. If we look back at the 4-hour chart, this looks like a little flag formation in a very bearish move. The momentum indicators are all in our favor. So as far as I'm concerned, this is now looking bearish. We've got a number of confirmation indicators. Rejection, 2 strong down days, a new low, consolidation, momentum in our favor on the 4-hour chart. This for me looks bearish. And if we can see a break of this low here, that would be further confirmation again. So that's why I had the fibs on here. And for this reason, I can now delete the orange one because it's no longer relevant, and it's the purple one which has led this particular move. But worth noting that when we had the correction back here, we had a slight new low, we had a correction back here. Don't be surprised if we're only making incremental moves to the downside here as we gradually edge back. It would be very in keeping with what's happened in Aussie dollar for quite some time. Dollar CAD, on the other hand, has been a lot stronger. Again, we always get. I really like the technical moves that we see in dollar CAD. We moved through the 200, 233-day simple moving average band. Let me just expand that out, get more data so that we can see the 200, 233-day band in the longer term. We can see that when we're coming up to this point here, yes, we had choppiness through here, but we found support here. We broke through here, we had resistance here, and that was confirmation of the move, and then we had a nice sharp sell-off. We ran into resistance here, and then we came up. We initially found some resistance, but we broke through. We've come back down. We made new highs along the way. That was a nice bullish confirmation on top of the initial moving average break. We came back. We tested it from above. We found support, confirmation of the break. We made new highs. Now we've made new highs. We've run into a bit of resistance again. We're seeing some consolidation, it would appear. Again, looking at the 4-hour chart, this is a notable area of support initially around 130, nice psychological level. I'm not going to hang my hat on it. If we do see a correction back and we break back below the 130.50s here, support here, I wouldn't be surprised if we move back into this kind of area here and we come back to a fib level and don't pay too much attention to 130. 130 is the most notable level initially, but again, I'm not going to hang my hat on that. But ultimately, this all looks bullish for me still. And again, I'm looking at these resistance levels. I'm more concerned with this one here maybe, but I will be keeping a close eye on how we respond at the 130, 160s, just because that was the prior support. Always interested to see how markets are responding at prior support and resistance. But broadly speaking, this is looking quite positive for me. And a breakthrough here then I'd be eyeing this kind of 33.50, 34 level. Again, prior resistance, prior support. But I'm not seeing any reason to question the bullishness of this. New higher highs. It's kind of flatlined here, but we are at very extreme levels on the stochastic. The moving averages on the MACD are continuing to push higher. The MACD histogram is potentially showing signs of weakness. If we continue to show signs of weakness and divergence heading into this level, then potentially that's a sign of a market exhaustion, indicating potentially a corrective move following what has been a strong rally since the start of Feb. But we've had a lot of bullish breakouts in the recently. So until we start to see that materialize, until we start to see some bearish breaks, then this continues to look bullish. But I'm very wary of potential exhaustion around these levels in the near to medium term. So something to very much keep an eye on. In sterling CAD, again, just like dollar CAD, we had a very nice bullish break. It's been a very good period since even longer here since September really. We've had another rally again since the start of Jan, in keeping with the moves in the pound in general, and a less hawkish Bank of Canada. The signal that we've had from the Bank of Canada recently is that they're effectively going to wait and see how the current policies impact the market. There has been a little bit of a cooling in the market, and it seems that people are anticipating a slower pace of tightening now after what was quite a rapid few rate hikes from the Bank of Canada. So we broke through 180 and 181 here, which was prior support. The next level highlighted around 185. We're not far from that. We've come as far as just above 184. We are in a bit of a consolidation. 185 is interests me at this moment in time. From a momentum perspective, things are still looking good. Potentially, we're seeing it reach some extreme levels on the stochastic. MACD still looks quite healthy. Bit of a corrective move. That's nothing to worry about. Even if we come back towards 180, 181, very intrigued to see how if we run into support around here. But broadly speaking, this still, just like dollar CAD, still continues to look quite bullish for me. I'm still quite pleased with this. Kiwi dollar. You may remember from the last video, we were watching these fib levels because we had this kind of double top pattern. We hadn't seen the break of the neckline yet. The consolidation of moving averages combining with the prior support seem to be holding for now. We've come back to the 61.8 fib. We've had a sharp rejection. We've had a nice little evening star formation here. Not textbook, not perfect, but the fact that we had a nice rise, we ran into a peak around the previous peak here, so technically a nice little setup here as well. And then we've got this this kind of shooting star candle, followed by a candle where we've opened, where we've failed to make a new high intraday and closed below the open of the 2 days prior. That's a very nice, as far as I'm concerned, evening star formation. We had a nice big sell-off after that as well. Bit of a retracement, and this is not a perfect Marubozu candle because it's got a tiny upper wick and a tiny lower wick, but this is a nice looking Marubozu candle Again, if you're going slightly off textbook, and the place that we've closed and failed to close above would roughly be the Morobozu line, around 50% of that candle. Then we've had another sell-off. So technically, this is looking quite bearish. The last hurdle is this support around 72, 71, 75. And I think a break of this, you're taking moving averages along the way. The moving average band, 200, 233-day simple moving average. You've got the 89 coming, following into play as well there. This could be a nice little bearish break should that materialize. You'll note that a number of these breaks which I'm talking about particularly signaling dollar strength as well, so it's worth noting that also. But I think this is looking quite bearish. Two peaks here, nice little neckline here, 61.8 fib rejection here, and a few nice bearish candles over the last few days. I think this is looking quite bearish, and we're just waiting now for that confirmation. We'll finish up with the yen pairs. Not much changed on dollar yen. We continue to make lower highs, so clearly the market's not particularly bullish. That 107 to 108 support that we had for so long has held as resistance. Failure to break through there would suggest a bearish market. We're still yet to make a new break to new lows, so we've clearly got strong support around 105, 105.50. Should that break, that could trigger another wave lower, and it seems that momentum is still with the bears. This may just be a consolidation mode. I think a break at that 1080 could take us back towards this kind of back into the cloud territory, but again, a bit ahead of ourselves. If we make a new higher high, then that may signal a move towards that direction. But right now, there's nothing really to me that stands out here that suggests we are going to see that. It looks as though pressure to the downside is building, at which point this will continue. This will start to look increasingly vulnerable should we continue to fail make these new higher highs. In terms of what we could see, if we do get a break below those levels, it's around the 104.30s, 104.50s, which start to become notable in the near term here. Prior resistance here, So that, and you can also see support as well back here as well. But really, I think that may even signal the potential for broader declines. 102.50, 102.75 looks like notable resistance and support previously as well, so that could become interesting and key. But right now, it looks like bearish momentum's building as opposed to being exhausted. Sterling yen, again, I think this is still looking bearish. We did have a temporary break of the 200, 233-day simple moving average. We failed to hold below there for too long. Again, the positive sterling story helping to lift that back above. We've run into resistance around 38.2 again, but for me this still looks like consolidation or corrective. I don't see bullish pressures building. 38.2 continues to hold for me at the moment. 50 is another interesting level around 150.80. You've got the culmination of the moving average bands as well there. Even if we get to 61.8 fib, we're back in the cloud, which could be a very interesting resistance test. Price support as well. I mean, personally, I'd love it if we got back into this level, especially if we had a nice little rotation off. That would be quite a bearish signal. But at the moment, we're even failing to break 38.2 at this stage, and it wouldn't surprise me if we just rotate lower off at this point. At which point, that would be a nice bearish sign, especially once we get confirmation of a breakthrough the 200, 233-day fibs, moving averages, and then a breakthrough that low would be further confirmation again. Finally, euro yen, similar to the pound, we've tested the bottom of this 200 to 33-day simple moving average band. We've broken through here a couple of times, failed to gather any major momentum. That could be that may be seen as a worrying sign. Equally, though, we failed to break back above this support zone around 130, 150, 132. Even if we do, around the 50 fib, you've got a cluster of resistance again. 133.50, you've got the 200, the 55.89 moving average, price support. Even above there, if we get towards the 61.8 fib around 134.50, you're back in the cloud, back at resistance zone, back at support. Again, I would love to see it reach this level, but I'm not convinced it will. That 38.2 is holding strong. 50, I think, would hold strong as well should we test that. You've got to remember that 55.89 band was strong support all this way up. Tested from below, that could provide strong resistance should it be given the opportunity. at which point a rotation low is possible, and you're looking for confirmation along the way, the ultimate which would be a break through that previous low. Should all this materialize as the markets are currently suggesting, all of these things seem to be pointing towards the same thing. The potential for a dollar recovery, the potential for a euro correction, the potential for a pound correction as well, and the potential for a yen recovery also. All of these things have been in a very strong trend, be it upwards or downwards, for quite some time. So it's potentially signaling a corrective phase of a longer term trend, which would be very, very interesting from a market's perspective. In terms of questions, I've just got the one: what overlay is this grey or black line mimicking the candlesticks? I'm not too sure what you're referring to, Jacob. If it's the outline of the candlesticks, that's just a available to update in the settings. If you're talking about the support or resistance lines, then that's just an indicator that can be found up here, and then you can color it as you wish. Aside from that, I'm not too sure what you may be referring to, but if you do have any questions about that, Michael Ichimoku. The Ichimoku, Michael, is it's just an indicator. It's widely used on yen pairs. It's widely used in Japan for things like the Nikkei, and it's effectively based on a similar theory of moving averages, mean reversion. It's like I say, the fact that it's widely used, I think, gives it an element of self-fulfillment. I don't use two of the lines on it, because even with this, I think that would I have a lot more faith in moving averages, for example, than I do with them, but they do give in signals of themselves. I like the clouds because it tells you whether something's bullish or bearish. It gives you support and resistance zones. I like the lagging line for confirmation. And I think the most important thing with it is it's not as complicated as it looks. I highly recommend having a little read up on it. I find it very useful, particularly on these yen pairs. The MAs, TAMI, my moving averages are simple moving averages, and they are 55.89 are the purple, 200 and 233 are the red. The reason why I chose these is I personally use a lot of Fib on my charts, Fibonacci that is. You'll see from the Fibonacci retracements. It's not something that I've seen others use, if I'm perfectly honest, but something I find to be quite effective myself. So the 55 is an adaptation of the 50, which is a very common moving average band choice. The 89 is just something that I've played with myself to see how well it works with the 89. I also tried it with the 34 as well, which was less effective for me. 200 is the most common moving average line in terms of support, resistance, bullish, bearish, and 233 again are just something I played with to test. And the combination of those two bands I've found to be most effective. And as you'll see with a lot of things that I use, Ichimoku cloud support and resistance zones, I don't like to look for precise areas of support and resistance. I like to look for zones. And the reason is that markets don't work to precision. We always have to give things room to breathe. We have to allow for an element of error. Whereas zones tend to work much better, because when markets are entering zones, then we can look for things like momentum to see if the market's particularly bullish rising into this resistance zone, or if it's losing some momentum heading into this resistance zone. And then you can start to look for key reversal signs, be they trades, be they setups, technical setups, candlestick setups. And that's why areas of importance to me matter far more than precise levels. I have no belief that it's easy to say to find a particular level and say this is the part which is going to reverse. And if you do believe that, then I think that's where you're going to find things quite difficult, because I think that people struggle with is not being able to pick precise levels. in my view, that's not important. You're looking for areas of rotation, and that's, once you accept that, I think it makes things a lot easier, and it makes it a lot easier to accept when you're wrong as well. So I've had a couple more questions, so bear with me a second. It's not organising. That's better. So the grey line, I think you're referring to the lagging line, maybe, which is part of the Ichimoku cloud. The lagging line is effectively just price action. I think it's 26 periods back. So you can see that it's exactly at the same point the price is now. The idea of it being that when it passes, price typically passes through the Ichimoku cloud first, and the passing through of the cloud of the lagging line is seen as confirmation of the initial break. Again, it's a very simple thing, but it is effective and used quite widely as well. Yes, Jeff, you're right. It is the Ichimoku with the lagging line. Let me see if there's any others. Nope, that's all. Thank you very much for joining us all today. Thank you very much for all your questions as well. The point of this is to engage and ask questions. If you've got any more questions that you've not thought of right now, you can reach out to me on Twitter. My Twitter handle is Craig_Forex. And apart from that, I wish you all the very best of luck with your trading this week. I hope you found this useful. Join us again, I think, in 2 weeks for the next webinar. But in the meantime, you can check out our videos, which are online. Check out our new podcast, which we've been doing with Jazz FM, which we talk a lot about the fundamentals, what's moving the markets. That can be found on iTunes now. It can be found on Audio Boom as well. You'll also find it on the Market Pulse website, which is where you'll also find the economic calendar. But apart from that, again, all the best of luck with your trading. Please do reach out to me on Twitter if you've got any questions or if you just want to chat. Apart from that, catch you all in a couple of weeks and speak to you again soon. Thank you.